Thank you very much for that introduction. I am the grandparent of 11 grandchildren. I'd rather just talk about that before the But Whitney told me I am to talk about. So she asked if I would speak. By the way, Whitney Wilkinson, a good friend of mine. I've known Whitney for at least 4 years.
Yeah.
And you're in good hands with her. So if you listen to her counsel, you will do well. I know I have whenever I've done. So we're here to talk today a little bit about banking and finance careers. Scintillating. You will go out of here just buzzing with enthusiasm for
like last week with the longboard. Now we're doing banking.
So we're going to talk. Well, I'll try to make this as interesting as I can because to me it is fascinatingly interesting. What all is important, all the important things that take place because of banking and finance in our local communities, in our nation, and certainly in the world. I've had the good fortune of spending my entire career as a banker. As was mentioned in my introduction, in 1983, 40 years ago, I got my first job as a part-time teller at the drive-up window for a bank that became KeyBank. And my job was to sort checks while I waited for customers to drive up and make their deposits. Back then, all the checks, everybody wrote checks. Nobody did anything electronically, and the checks would come in a big batch, and I would sort through them and put them in envelopes that we would then mail to our customers. Things have changed dramatically in the industry over the last 4 years, but not that dramatically. Banking is probably one of the most slow to adopt new technology industries that exists. From that time, though, I worked in the retail banking world. You think of banks, probably most of you, when I say, what do you think of a bank? You think of the local bank or credit union, maybe where you do your business. If you happen to have a check and like grandma sends you a check, what do I do with this? I don't know what I'm supposed to do with it. Oh, I take a picture of it and it goes to my bank. But retail banking is ubiquitous. It's everywhere. You see branches of banks all over the place. But there's a lot of other kinds of banking that takes place. And I've had the good fortune of working in a variety of different positions in banking that have allowed me to work on both coasts, as was mentioned. So I worked in New York for Bank of America and for Key Corporation back there. I worked in Oregon for a community bank. I had the opportunity to acquire a bank, an FDIC failed institution. It was an FDIC-assisted merger. That was an exciting experience. I had an opportunity to take a bank public, so a privately held company, to go out into the markets and raise capital so that we could take a bank public. So those were some exciting aspects of my career. So those are some things that we'll talk about today. I would love feedback or interaction. If you have questions as we go, certainly we can do that. I will leave time at the end as well for questions. So for you all, what does your future career in banking and finance look like? Well, I would say it depends on a lot of factors. As I mentioned, there's such a broad range of careers that one could have in banking that a lot of things really will impact that. What type of institution you work for. You could work for a public-facing, client-facing organization, or you could work for an organization that everything's kind of behind the scenes. You could work for a very large organization. You may want to specialize in a particular area. I've had the opportunity to specialize in wealth management, business banking, commercial banking, retail banking, operations. So I've had a number of different specializations that I've focused on in my career. So you may have some things that you're really good at, and that might be what draws you to a particular institution to work at. Your educational background and your interests and personality, I would argue, are probably the two things that you should focus most on in terms of what kind of a career you might have in the financial services arena. Because if you are the ultimate extrovert, if you are somebody who is good with numbers, but also just loves people, loves being out there, whatever. There's a particular type of bank that you should probably look at working at if you're interested in banking. On the other hand, if you're, look, I don't want to talk, I don't want to stand in front of people, I don't like to talk, I'm very uncomfortable with interacting with the public, then you may want to focus on a very different type of work. If you're good at coding, if you're good at project management, those kinds of things, there's lots of jobs that don't require huge interaction, certainly with strangers. And so banks have lots of opportunity for careers. If you're interested in a career in banking, if whatever you do, I would say it could tie in to a career in banking. That's how broad banking is. And so we'll try to narrow some things down, because at the end of the day, what's important to all of you is to have an experience not unlike mine. When I was in school, the reason I got a job as a teller at a bank, at the time I was working as a delivery boy for a meat packing plant. Well, that's an exciting job, right? You get that raw hamburger and you get to throw it in the truck and drive it to the restaurant and load it on a pallet and haul it off. So that was my job. And I thought, let me think about this. How is that going to look on a resume when I get my degree in business? Not so good. So I decided to move into a banking career because I took a class at the University of Utah called Money and Banking. I thought, well, I like money, so I'll maybe learn about that. And it just opened my eyes to the possibilities of working in that world. So you might be, yes.
Well, feel free to finish your point. I just wanted to see, since you do want to talk about your grandkids, and you mentioned that you're a wealth management specialist, like what advice would you give them at this point?
Yeah, so I'll have them actually follow the same advice that I did. The sooner you start saving, the better off you will be. So I'm not 65 yet, I'm 62, and I retired at 60. The reason I could retire at 60 was because when I was 21, the government came out with this new thing, and it was called a 401k. And you've all probably heard of 401ks and Roth IRAs and different types of savings instruments. What happened was I was a student at the University of Utah, and I was taking a class, and the class was about the Social Security Trust Fund. One of the topics was, and I was to write a paper on the Social Security Trust Fund. And I looked at it, and it had this forecasted out, when is the Social Security Trust Fund going to run out of money? And it was the year I turned 65. Okay, no bueno, right? This is not going to work for me. I'm going to have to save for my own retirement. And lo and behold, here comes this investment vehicle that's available to people. If you start saving when you're 50 for retirement, you'll never be able to save enough to retire. If you start when you're 25, you're all probably in your 20s, 30s, some of you a little bit older maybe, but if you start now, what's the Chinese proverb? The best time to plant a tree, when? 20 years ago, right? 10 years ago. The next best time is right now, okay? Start now to save a little bit. It may feel like, man, I barely have enough to make it, but small sacrifices today with a little bit of savings accumulate. This is a wonderful blessing of compounding interest. Money compounds, it grows if you just put it aside on a regular basis and let it do its thing. So that would be my advice.
Well, but where are you putting it that it's growing faster than inflation?
Well, until last year, the previous 10 years, it was easy to grow faster than inflation. And there are a number of things. So for my grandkids right now, I'm buying Series I bonds. They're paying like 9% interest. Crazy. Okay. So that's something that I just have done for them. I started, every one of my grandkids turned 1 year old. I put a chunk of money into an account, and then I added to it every 2 weeks. That was just something I did for them. And then that money has grown to now where I can put it in other safe investments. There's 529 plans, which are educational plans that money can go into that's just for education, but there's a lot of different pretty safe investments that one can make. Right now, there's lots of like, you know, money market funds that are paying, you know, over 5%, which is not keeping pace with what inflation was, but over time, we anticipate that all the efforts of the Federal Reserve Bank to lower, to slow down the economy will also lower the inflationary impact that we're having on interest rates. Does that help?
Thank you.
Okay.
And then what about like houses or like property as investments? What's your thoughts on that?
Oh yeah, sure. Go out and buy 3 houses and rent 2 of them out. You all have enough capital to do that, right? That's the big problem with housing right now. Is It's just overhyped. It's overinflated in terms of the cost of housing. But again, saving money now to be able to put it into real estate is, you know, obviously a good investment. It's not a foolproof investment. Anybody that's been around since 2007 knows that real estate can also burn you if you get in at the wrong time or too high of a point in the cycle. So, did you have a question back there?
No.
Okay. Okay. So, this interest in personality. If you have the personality of a person without a soul, then banking is for you. Because, as this cartoon points out, the bank would like to help you get back on your feet. We're repossessing your car, okay? Bankers are known to lend you an umbrella when the sun shines and repossess it when it starts to rain, okay? That's one of the jokes about banking is, you know, it's hard to get a loan from a bank or whatever, but banks are also held to a very fiduciary responsibility because, and we'll talk a little bit about that as time goes on today. So, you know, when people ask me what I did for my career, I'll tell them I was a banker. And inevitably, the eyes glaze over and they're like, Jesus, this is going to be. But sometimes it's like, well, what kind of a banker? Okay, so there are a lot of different types of banking. And we'll talk about these briefly, but I'm happy to elaborate on any of these if you'd like. So investment banking, that's Wall Street banking. These are the bankers that get the bad rap for causing the financial meltdown of 2007, 8, 9, 10, okay? Because what they did is investment bankers, among other things, they create financial instruments, investments that people can put money into, right? Mortgage-backed securities was the thing that got them. They created mortgage-backed securities that weren't backed by really strong, good mortgages. And so as the mortgages started to fail, the securities became as worthless as the paper they were written on. But investment bankers also do things like merger, acquisition, that kind of big ticket. They take companies public. So when my bank that I worked for, when we took that company public, we worked with investment bankers. We were banking experts, but we weren't investment banking experts. So whenever you see at the end of the day at Wall Street and they're ringing a bell and some guy, like who's that guy ringing the bell on Wall Street? It's usually the company that went public that day that's doing that. So that's what investment bankers do. They're big, Wall Street, you know, New York-based bankers typically. They wear fancy suits and they work long hours. Okay, it's a rough job, but it pays well, very well. Commercial banking is what I did. Commercial banking would be sort of the term you would use for the local branch of, you know, KeyBank, Wells Fargo Bank, Zions Bank. You know, the banks that you're familiar with, the names you're familiar with. That's commercial banking. They do commercial lending, so they loan to businesses. Small businesses, large businesses, up to the medium-sized business, maybe $100 million and under in revenues, would be dealt with by commercial bankers. Yes.
What is your opinion on like getting loans and credit as a small business through a commercial bank versus like a credit union? I don't know if you know anything about that.
Yeah, I think that they both have regulatory oversight guidance, and so a and they're all both operating in a competitive environment, meaning that you're not going to get hosed over by, you know, one or the other. There is a difference. I'll talk about credit unions. You see, I've got them listed here, but commercial banks that's what they have always done, is commercial lending. Credit unions typically have been more consumer oriented, car loans, mortgages, you know, second mortgages, those kinds of things for individuals as opposed to business lending. Now they're getting more and more into commercial lending for purchasing a building for a business or something like that. So credit unions have an ability to do that, but they're somewhat curtailed by the nature of their organization and where the deposits and their funding comes from. We'll talk about that in a bit too.
And then one more question. How do you even start like building credit as a small business?
Yeah, that's the toughest part of being a small business, is because, right, if you don't have the ability to prove that you can pay the loan back, you can't get the loan. And banks, you know, are notorious for not, you know, loaning to companies on the sort of the promise of future success. They're more looking at the reality of past success. So the way to get around that for banking of a small business is oftentimes the SBA. So the government has programs that will enable businesses to borrow with government guarantees that sort of appease the bankers, but also allow the business owner to get their funding. They're not free, they're not even cheap, but it's a way to open the door to you know, to get financed as a business. The other thing is banks will look at the other types of financing you do. So small businesses loan money and borrow money. They don't call it that. They sell on credit and they buy on credit, right? So you have accounts receivable, accounts payable. Those, your performance of accounts payable and receivables oftentimes also are a good indicator to a banker that this person knows their business and they know how to manage the trade cycle. That help? Mm-hmm. Private banking. So private banking is for the very elite, the very, very high net worth individuals. Private bankers, and I manage the private banking group for a bank locally here, not Zion where I retired from, but Key Bank. Private banking and wealth management. So private banking for the very elite, these are the people who, you know, we fly you to you know, go see Taylor Swift in Las Vegas or whatever. You know, private banking is really more concierge service for people. They've made their millions. They need somebody to sort of manage their money, but also create events and experiences for them. So if you're into that kind of thing, you know, getting in tune with a private banking organization, you know, might make sense for you. Private offices sometimes exist for businesses, for high net worth individuals. A private office is just, they manage all the financial affairs so that the people can go and enjoy their money. Private banking is pretty niche and pretty small in terms of the number of people in it. So for what it's worth. Wealth management. Okay, wealth management is important for anybody that has any kind of wealth. The more wealth you have, the more important wealth management is. And that's simply tax planning, estate planning, investing. So wealth management in the world I'm from, where I manage wealth management, somebody would say, I have X million dollars. I'm going to give it to you and I'm going to trust you to manage my money in alignment with my risk tolerances. So I'm 25, I'm a tech millionaire, and I want to make bank, right? That's a different investment sort of strategy that you put together for that person than for Steve Eyre, who's 62 and has the money that he's worked hard over years to accumulate. My wealth manager, who manages my money, has a much more conservative approach. I can't afford to lose all my money. The tech millionaire can lose it and make it back, right, with the next great thing. So risk tolerances change over the course of one's career, life, whatever you want to call it. Wealth management does a lot of things to kind of help people maintain or preserve the wealth that they've already accumulated. Different than commercial banking or retail banking, where you're trying to help people create some wealth. Mortgage banking, as the name implies, is just that. It's people who just specialize in making mortgages. So you'll have a company that is not a bank, but they do banking, and it's like Rocket Mortgage, okay? They're not a traditional bank, but they do mortgages. Mortgages are a type of lending instrument that's very specific to real estate secured transactions. So we think of mortgages as home purchases. You talked about that, but mortgage banking sometimes also applies to lending for commercial mortgages, larger buildings, those types of things. Especially finance, like credit card companies. So some of the largest companies in the world, American Express, they're not really a bank, but they're a specialty finance company. Okay? They just do credit cards. There are other specialty finance companies, like sometimes you'll go and you'll want to buy something and go to the dentist. You know, you go to the dentist and you need your wisdom teeth out, and it's like, well, it's going to cost you $2,000. But if you want to sign up for our payment plan, we can do, you know, well, the dentist isn't financing that. They're using a specialty finance company that will allow you to make those payments at their 21% interest rate. So that's what specialty finance is. You mentioned credit unions. So credit unions started, Utah is one of the big credit union states in the country. Credit unions started as really an answer to the question that you asked earlier, which is like, how do you kind of get going on this stuff, like a business or whatever? It was, well, when banks won't give us credit, what are we supposed to do, right? Well, we're all sitting in this room and you have money and you need money. Well, what if I take your money and I loan it to you at a fair interest rate, whatever? That's what credit unions were designed to do. Take a group of people with a common field of interest. So it could be they all work for the same company, they all live in the same community. Those kinds of things is what credit unions were sort of originally founded on. And they were designed to be, you know, an option outside of the traditional bank channel, which limited some people in the access to credit. So that's how credit unions got their start. They've grown and they've become very large. I think America First Credit Union and Mountain America Credit Union are two of the largest financial institutions in Utah, despite the fact that they, you know, they should have a limited field of membership. But the Utah law changed several years ago, I think in the 90s, to allow the field of membership to be you live or something. I don't know, it's crazy. So they pretty much can go anywhere. America First, I noticed this the other day. I was watching a football game. They're supposed to stay within a state. Credit unions typically would reside within one state. I'm watching the Arizona State football team play, and they're playing at America First Field. So they've clearly gone into Arizona with their company. But credit unions typically would be, you know, they're nonprofit. That's the big advantages credit unions have, is they're nonprofit, therefore they don't have to pay taxes. They also they're not publicly traded companies, so you can't buy stock in a credit union. So it's a different sort of organizational structure at a credit union. But the idea being, well, if we're taking Joe's money and we're loaning it to Susie, and we're not making any profit on the deal, we ought to be able to lower our interest rate compared to what maybe a bank would charge. You also have to make enough to have a profit, right? So that's how credit unions come into play. Industrial banks are unique to Utah. Utah has special banking laws that encourage the formation of industrial banks. You probably haven't even heard of most of them. BMW Bank, Pitney Bowes Bank. Anyway, there's Web Bank. You might have heard of Web Bank, but these are banks that are organized to sort of provide the banking needs of a particular industry. So I don't even know what BMW Bank does, but I guess their financing arm of when you buy a BMW, their financing can go through BMW Bank. So they're like, why would I sell my car and not take the profit from the financing of my car to my own benefit, right? So they formed their own bank. But Utah created laws that enable the creation of industrial banks. And that's what they are. They're just specialty banks who just finance for a particular company or a particular very, very, very closely defined niche. Private equity firms. So now we're getting out of the public sector into private sector. You guys know what private equity is? You've heard of private equity?
Investment capital.
Like that. So I'm a business, and I want to take my business to the next level, or I'm ready to retire, and nobody's like, there's no heir apparent to take over my business. A private equity firm is a firm who takes private money, not public deposits, but private money, and they go and they buy companies. That's what private equity is. It's investing in companies using private funds. Those funds, then the return on that can be very high, but it's also much riskier because you're buying a company that maybe isn't as proven or whatever. And so private equity is a form of accessing the capital market for businesses that may otherwise not have that same opportunity through a traditional bank. So, for example, a bank is not as likely to finance the sale of a business to a stranger, because the guy that built the business or the woman that built the business, they're out. Without them in that business, is it still going to be viable? We don't know. So private equity banks will oftentimes pass on that kind of a financing option, whereas private equity will say, well, we'll give you the money to sell the business to this person over here, but we're going to put somebody on the board. We're going to be actively part of the management team to make sure that the business doesn't, fall on bad times. Private equity can do that. A bank can't do that. A bank's not. There are fiduciary responsibilities to own the companies that we do business with, would not allow us to step in and tell them how to run their business. So that's private equity. And then, of course, international banking. That's, as the name implies, that's just banking across borders. Companies that have multiple operations in multiple countries. International banking becomes very important for them to be able to manage things like exchange rates. I mean, every day, the dollar against the yen or the dollar against the yuan or whatever, currency you might be looking at is going to be moving up and down and changing. So people who are constantly monitoring those kinds of things fall into that international banking world. Okay. As I mentioned, as we went through that, I've worked in a lot. I've never worked at a credit union or an industrial bank. I have worked with very closely private equity. Certainly I've worked in mortgage banking, wealth management, private banking, commercial banking, and worked with investment banking. So I have some experience with most of these types of financial institutions. Yes?
I wanted to ask, companies like Visa, MasterCard, like Discover, what do they fall under?
So they would fall under that specialty finance. Visa, MasterCard, all they do is the credit card, right? I mean, pretty much. So they're a specialty finance company. They're still regulated. We won't talk a lot about regulation, but no, the banking in general is a highly regulated industry. It's not as highly regulated as it once was, but it's still, like when I started in banking, just before I started actually, banking regulations were completely regulated. The government told you how much you could earn on deposits, how much you could pay on deposits, and how much you could charge on loans. And that was it. You just did what they told you. So banks became just order takers. Oh, you want a deposit? Okay, we'll pay you 1%. You want a loan? We'll charge you 5%. 4% is our margin. or whatever. That changed when deregulation took place. But specialty finance companies like Visa, MasterCard, they pretty much do one thing. Now, you'll see some of these companies, like for Capital One, they're a big credit card company. They're also a bank, because now they need, right, these companies, when you use your card, where does the money come from? There's got to be something backing that up, right? And so they have to have money backing up the use of credit that people are doing. And so sometimes they'll get a banking charter so that they can gather deposits and they can have funds to back up the credit that's being used.
How does the government get out of that one? Right? Because
anytime you're doing that, you're regulating. Anytime it's somebody else's funds that are being used to finance any kind of a loan or a credit, extension of credit, the government is regulated. It has a regulatory arm that reaches out and touches that, monitors, makes sure that they're not. They do have limitations on interest rates as well, but they're not very good. I mean, right now, if you have a credit card, I guarantee you're probably paying more than 21% if you don't pay it off every month. So that's the other thing I would say. As a banker, like I made my money off people borrowing money and paying interest. But I would say to consumers, man, anything you can do to avoid carrying a balance on your credit card month after month. It's hard when you're a student, you're struggling, whatever, but at the end of the day, the more you can avoid paying interest, faster your accumulation of wealth can take place. You have a question?
Yes, I do. How would you, how does the bank assess and manage risk associated with business lending and investment portfolios?
Well, there's two questions there. So for business lending, a bank assesses risk by looking at past performance of the business. So we look at the sales of the business, we look at the profitability, we look at the industry the business is in, we compare the performance of the business to their peers. So banks, the nice thing about banks and being long-time lenders over hundreds of years is we can accumulate data that would tell us that a business that manufactures automobiles should have a profit margin in this range. If we see a business that's way below that, that's a more risky proposition to us than one that maybe is in or above the range. So we analyze against other companies that are like the one that's borrowing, and we also analyze the company itself based on those really primary factors of profitability, growth, management capability. Those are the things that we look at. So for an investment portfolio, if we're loaning against an investment portfolio that I'm thinking of would be like a pool of assets that somebody owns and they want to borrow against that. We look at liquidity, the availability, the ability for a bank to attach, itself to that as a lender. So at the end of the day, most banks are not looking to make lots of loans that are on an unsecured basis. They're always looking for some underlying collateral that can secure the loan in the event cash flow goes away and the company or the individual is not able to pay it. Does that help answer that question?
Yeah, it helps a lot, yes. It gives me a better understanding on, like, if I were to go fully into a business, I need to actually account for, providing the bank that I could cover what I'm actually borrowing to start the business, and that's really helpful.
Yeah, and the nice thing is, so I mentioned SBA earlier. A lot of times that are going into it, people that are going into a business, they're looking, where am I going to get my money to get started or whatever, and how am I going to qualify? What can I do to show these lenders that I'm a viable candidate for a loan? The SBA has a program for making loans, but they also have, there's a group called SCORE. It's a senior core of retired executives, and this group of people they're nonprofit and they're only there to help new businesses do things like write business plans. Look at, does this business make sense, what they're asking for, whatever, those kinds of things. So they advise new business owners on how to go about maybe, making it a viable proposition as opposed to something that the bank goes, oh, not even a chance, right? So if you're actually interested in starting your own business or maybe acquiring a business, I would always recommend that you go and meet with the SCORE representative, SCORE. They would be people that would have knowledge and experience in how best to position yourself or your business for financing.
We
Okay.
also have a class in entrepreneurship. We have an entrepreneurship.
Yeah.
class. Yeah.
Yeah.
Do a business plan.
Okay.
Is that John? Wait.
Bill Nelson or Tom.
Okay.
Yeah.
And a
So,
follow-up question to that
Yes.
is you're talking about like having security behind a loan.
Mhm.
So if you, for instance, have like a car a company vehicle, and you put that up as collateral
Yes.
for the loan?
Of course. Yeah.
And then how do you get a SCORE representative? I just Googled that.
Yeah. I would just look up SCORE and you'll still say senior core retired executives. You can just, yeah.
Okay. Thank you.
All right. Since you've had so many questions, would you please read this one for me?
A successful career in banking depends on an ability to understand the one ingredient that all banks require to survive from one day to the next. Yeah.
Oh my gosh. Oops. Theory. That ingredient is OPM. Other people's money.
Thanks, Siri.
Oh, man. That's embarrassing. Now it's embarrassing. You hear about those guys who robbed opioids from pharmacies overnight? Okay, it's not opium, it's OPM, other people's money. Every one of those banks that I showed you, they don't have this big pool of money that they're just like, what am I going to do with this, right? Banks depend on the deposits from depositors in order to have funds to lend out. Now they can't lend every dollar that's deposited out. So the more deposits a bank can raise, the more loans they can make. Okay. Deposits on a bank balance sheet are considered a liability. Now, on your personal balance sheet, a deposit is an asset, right? It's money that you have, it's something that's yours, and it's got value. But on a bank balance sheet, deposits are a liability. So, and on a bank balance sheet, loans are an asset, right? Because loans are earning assets. Loans made by banks are where revenue comes in from a bank. Deposits, we have to pay money out on deposits, so they become a liability for a bank. But a lack of deposits is a liability to the survivability of a bank. Anybody ever heard of Silicon Valley Bank? You should have, because it's the second largest bank failure that's ever happened in this country, and it happened earlier this year. Okay, we'll talk about what happened there. So Silicon Valley Bank is a very specialty bank. Silicon Valley is where what happens? Who's in Silicon Valley right now? Let's see. There's Google, there's Facebook, right? I mean, it's tech. It's the tech world, whatever you call it, the tech central, right? Are these businesses that traditional banks want to loan to? Startups with some great idea that's not going to be profitable for 2 years or 3 or 4? That's not a traditional bank client. But Silicon Valley Bank says, we're going to loan to those people, but we'll loan in a very specialized way. But what we'll do is we'll partner with all these private equity firms, because what are private equity firms? They're people who have tons of money, cash, and they put them into businesses. So they'll give this business $10, $20 million. And where does that money go? They don't spend it all today. you've heard of burn rates, you know, and burn rates are these businesses that aren't profitable yet, but they're spending the cash the private equity firms gave them. So those private equity firms give them the cash goes where? The bank that's going to loan them the money, into Silicon Valley Bank. So Silicon Valley Bank's balance sheet looks very different than a traditional bank. They've got tons of deposits, tons of them, because they get, you know, they got this business that wants, you know, a $2 million loan, and they've got 15 or $20 million that they can put in the bank, right? So they think, oh, okay, good loan prospect. So they've got all this money. What are they going to do with the money? Well, banks have two ways to make money off of deposits. One is they loan them out. They can loan the money out. Silicon Valley Bank couldn't loan all the money they had in deposits out. So they went to the second option, which is they invest in securities. They invest in very safe bonds, okay? Now a bond, Whitney,
Oh, no.
let's go, we're gonna do a learning experiment. Okay. If I was to give you, if you were to give me like $100 and I was going to pay you back at an interest rate of 2%, okay, that transaction has a certain value. It's like maybe 102%, right? $102, say, whatever. Let's just say that that's how much that's worth. And then Russell over here says, hey, Whitney, I need to borrow $100 from you. And now the going rate is $5, 5%. So I'll borrow $100 from you and I'll pay you at an interest rate of 5%. Which one is more valuable to you, my 2% or his 5%?
Well, 5, right?
His 5% is worth more, okay? So what happened with Silicon Valley Bank is they had all these bonds that they bought, and the bonds paid 2 and 3 and 1 and 2%, right? They were paying low interest rates because that's what the interest rate environment was for all those years. So they had all those funds, and now the going rate for that same amount of money over that same period of time is higher. Well, when rates go up, bond prices go down, okay? So when prices go down, it's okay because they're still going to get all the money back, right? But it's not okay because the government requires them to do a thing called mark to market. They have to say, our bond portfolio is worth less today than it was when we originally put it together because interest rates have gone up. So rising interest rates caused a big problem for Silicon Valley Bank. Not in liquidity even, but in terms of the risk of their portfolio, because it was worth less and it had to be marked down. When you mark something down, capital is eroded and profitability is eroded. Now, here come the regulators, and they start looking at Silicon Valley Bank and they go, yeah, we're not real keen on this big chunk of funds you have at low rates. So we're gonna give you a memorandum of understanding that you're gonna do something about it. You're gonna take some losses now, you're gonna retool your balance sheet, you're gonna get back in the market with higher rates, everything will be fine, except one thing happened. These private equity firms that put all that money into those companies and told all those companies, you need to bank at Silicon Valley Bank. 2 or 3 of those private equity firms said to those investors, we're uncomfortable with Silicon Valley Bank. Your money may not be safe at Silicon Valley Bank. Recognize that FDIC insurance only covers up to $250,000. If I've got $20 million sitting in a bank and it's only going to be good for $250 if the bank fails, I'm nervous. So 2 or 3 of these large private equity firms literally put them out of business. They told their people, take your money out, go find a safe harbor somewhere. They pulled their money, they put it in Chase, they put it in Wells Fargo, they put it somewhere else that was not Silicon Valley Bank. It became a run on deposits. Now, a run on deposits is what caused the Great Depression of 2009. 1929, okay? A run on deposits is what sunk Silicon Valley Bank. But in today's electronic world, how do you have a run on deposits? They don't line up outside the bank for, around the block. They push a button and the money goes away into some other bank. And that happened in 2 days' time. That company went from we're okay to we're in trouble to receivership. FDIC had to step in and the federal government had to bail out that bank. Had they allowed things to run their course, millions of depositors would have lost billions of dollars, because I think it was $43 billion exited that bank in a matter of days, but there were still over $100 billion that were there on deposits. Think about how many of those depositors would have lost money. The FDIC would have had to step up and pay just the 250. Every bit above that would have been economic, like Armageddon. So yes, the government bailed them out, helped them out. What happened is another bank came in, took over with government assistance, very much like the bank that I was a part of acquiring. That bank failed for a different reason, but the FDIC said, we can't run banks. If banks start failing all over the country, which they did in 2007, 8, 9, we can't run them all. We need good, strong banks that are viable, that have capital to come in and run those organizations. And remember I told you I took a bank public? We took the bank public in 2007, right as the financial crisis hit. We're sitting there as a bank with all this capital and nowhere to put it, right? And so we were able to acquire a bank by virtue of the fact that we were highly capitalized and ideally a well-run organization. So that's what happened at Silicon Valley Bank. So beware of, rising interest rates have this ripple effect, right? It's costing everybody here more money to borrow. It's designed by the Fed to do one thing, and that's to bring down the pace of growth in the economy. But economies are very fragile things, and banks are a very big part of the economies. Okay, so these are the different sizes of banks. I don't think in the interest of time we need to spend a lot of time on this, other than this too big to fail. That's actually a term that they use in the industry now. Right now, Wells Fargo, Chase, JP Morgan Chase, Bank of America, maybe US Bank, the very largest of the banking organizations are deemed too big to fail. They will not be allowed to fail by the federal government. Other banks will be allowed to fail, but these big ones who have nationwide footprints, millions of customers, are much more highly scrutinized. The decisions they make, anybody bank with Wells Fargo and have a credit card that you didn't apply for?
Yeah.
Okay, that happens. Banks, they billions of dollars of fines to Wells Fargo for doing that.
And
that
then
was bad.
there was a class action lawsuit, right. And they gave you like $49.
Yeah. But these big banks are, that's what the giant banks are. National banks are banks that have kind of a mostly national footprint. I'll use KeyBank as an example. KeyBank's not in every state, but they're in a lot of states, okay? And then regional banks would fall into the category of like Zions Bank or Valley National Bank down in, let's see, you're from Boise? Are you from Boise? You got your Broncos thing, or is that the Denver Broncos? Okay. Anyway, so there are banks that just sort of serve a particular region of the country. And then local banks are, little banks like Utah Bank and Trust is a local bank. They're pretty much only here. Cache Valley Bank, so there's a few banks like that. All right, and then specialty banks would be like Web Bank. Web Bank is a traditional bank in that they gather deposits, most only CDs. They don't have like regular deposits, but they gather CDs, pay an interest on CDs, and then they loan money out, utilizing technology and the web. I'm just going to take I'm sorry, I'm rambling too much here, but so banking institutions are critical to the economy. When the COVID-19, who remembers when in February, it's late February, early March, 2020, the world stopped. I mean, it was like, we're done. Everything shut down. Businesses were shuttered. Restaurants were they were out of business. And a lot of businesses suffered right during that time. So much so that the government immediately said, we got to step in and do something. As government tends to do, get out the shovel and start throwing money at it, right? And they did, and they put a multi-trillion-dollar package together called the CARES Act, but a big part of that was Paycheck Protection Program loans. These were loans administered by the SBA. Well, do you think the government has enough employees to go to every business in this country and say, we can loan you some money at a 0% or a 1% interest rate, and if you pay it, if you keep your employees on payroll, we'll forgive the loan? That's a good loan. Who wouldn't want that loan, right? To keep their doors open, to keep their employees there so that when the doors can reopen, they have something to do. That's what paycheck protection loans were for. The SBA was the logical government agency to administer that program, but banks had to be the ones who actually did the work. They had to meet with customers, they had to fund the loans, they had to do everything. And so I had the opportunity, I say job preservation for employers and job creation for banks. Paycheck protection program loans were all about keeping employees with a paycheck. That's what it was for. For banks, though, the banks, like I work for Zions Bank, we were one of the, Zions Bank is Zions Bank Corporation, which is a company that owns multiple banks in the Intermountain area. Zions Bank Corporation has, I don't know, they're the 35th largest bank in the country. We were the 4th or 5th largest producer of paycheck protection program loans. The reason for that, my group was the one that did that. Well, what did we do that the other banks didn't do? We figured out how to use automation. We created an entirely automated process for applying for, receiving money, going through that program. So our customer base, by and large, had an easy way of getting access to that government funding. And again, without the banking channel, there was no way those loans were going to be done. Okay. We'll skip. Yes.
So with the process being automated, did you notice, like, was there more reports of fraud from the automated systems?
Yes, there was more fraud. There continues to be fraud in that program because unlike a traditional loan, all they had to do was say how many employees they had, say what their profits were, and so unfortunately, there was the government did not want banks to get hung up on verifying the information. So they had to produce like government things like tax returns and things like that. So there was a lot that could be done to try to validate. But at the end of the day, if somebody wanted to, they could have gotten away with and did get away with, multiple loans, or that's the thing that was tough. Now, the SBA had checks and balances for that. So any business that submitted a loan went into the SBA's database. If another loan was applied for by that same business, it was rejected. So there were things to prevent fraud, but anytime you have a loan that's based strictly on whatever the client sort of represents as truth, you're going to have a risk of that. It's an unfortunate reality of that situation. But I think by and large, the number of businesses that were legitimate, that legitimately profited and benefited from paycheck protection program loans outweighed the cost of the fraud that was taking place. Okay, I'm going to, let's see.
We're just about.
Yeah, about time. So I'm happy to answer any other questions you have. I'm going to put this up here so that if you have anything that sort of jumps out at you from this list of jobs that you might have in a bank, raise your hand and tell me, and I'll tell you kind of what's involved with it. But I've done or worked with people in virtually all of these areas. Again, the outgoing, extroverts, that business development, that's a good job. You ought to be doing that. Operations, that's behind the scenes. That's doing the stuff like we did. We created an automated process. We used systems analysts and engineering to do that. So I had to have people who were capable technologically to create. We utilized Facebook, for the process of supplying information and gathering information from customers. So project management, banks have tons of things that they need project management for. And business process management, that's fixing something that's broken, making it better, operate more smoothly, and many, many more things. So there are hundreds and hundreds of different types of careers that you could have in the financial services industry. And they're not all, what you think of when you think of a bank, which is back to that cartoon, kicking old widows out of their house, that type of thing. Other questions?
Yeah,
Yes.
you have a question. With Zion, how did the team support local businesses and contribute to the economic development of the community they serve?
Well, I'm proud of the fact that I work for Zions Bank Corp. Zions is a very large, the largest bank in Utah. Very committed to the customer base that it serves. Zions does not serve a client base of mega businesses. They serve small business in particular, primarily. Small business is the engine that drives this economy for the country, certainly for this local economy. Small bit for every large business like Ford Motor Company, there are 10,000 small businesses. So the small businesses is where people work. It's where people, go home and take their paycheck and take care of a family and what have you. And so Zion's focus on that client base and on the consumer client base that is, very connected and loyal to that company. That was the thing that sort of gave me great satisfaction working with them. I work for the bank corporation, so I work for the group of banks that the Zions owns, they're in Idaho and California and Washington, Oregon, Texas, Nevada, Arizona. So anyway, I guess that's what I would say is that Zions they're not one-trick ponies. They will take care of a lot of different kinds of businesses, but mostly smaller businesses. And that's the group that I retired from, was managing the backroom underwriting operations for all of the organizations that Zions owns. Yes.
Okay, really quickly, I wanted to ask you about the educational requirement you have to get into any of these careers. Do you require a 4-year degree for any of these areas? Are there any areas you can get into with a 2-year degree?
Yes. Yeah. So any of these systems analysis or engineering, or if you have a tech, like certain certificates in the technical world, you can get jobs there. Lots of project management jobs or project analyst jobs don't require the 4-year degree. You don't have to have an MBA to get into almost any of these, really, unless you're really in the C-level kind of supporting C-level activity in an organization. But I encourage you, if there's anything that interests you in a career in banking, you can route a question through with me, and I'd be happy to answer those questions. But if you're interested, the nice thing about it is because Zions is headquartered here. That's one bank where you can have access to a lot of different jobs right here locally. They have a huge campus out south, and they do all of these things at that campus. So if you're interested in working for a bank, it's right on the tracks line, and you can just get out to that location.
And do you have a tuition benefit for your employees?
We do, yes. It's not for all employees, it's not across the board, but for many positions, the bank will support and pay a percentage of, or in some cases, all of the tuition. Yes.
So, going back to the small businesses and all that. Also, what do you recommend to one business, small business, to do after getting the loan? Also, you said Discord or what else?
Well, so after getting a loan, use the loan as intended. In other words, don't get too excited about spending all the money, right? If it's used, like there's a line of credit, for example, use it appropriately to manage the cash flow cycle. That means use the money, buy the inventory, sell the inventory, then pay the thing off, you know, that kind of thing, as opposed to getting like, oh, I'm going to use this line of credit to go buy a car. Well, that's great, but now the car doesn't generate any revenue for you, and you got to pay it, and that's not the intent. So that would be my recommendation.
All right, well, thank you so much.
Oh, one last slide. For all of you guys that are about to graduate, take back student loans.